Yo, what's up, everybody? This is Kia Keeley, and welcome to the technical analysis section. And in this section, I'm going to be covering technical analysis, reading charts, what time frames to use, support and resistance, what indicators I use, and identifying patterns in the stock market. And my initial purpose in terms of covering this is because I know that technical analysis is very intimidating. It's very intimidating to look at all of these charts, to look at all these candlesticks, and a lot of people don't even know what candlesticks are, and trying to memorize patterns all the time and identifying patterns just to initialize a stock trade. I remember that my initial point in terms of getting interested in the stock market, that I thought this was impossible. you know, I definitely thought it was impossible because the way that a lot of YouTubers teach it, or at least what they present it with, is like an information overflow, you know, and it seems that only the most advanced of traders can understand this, or people who've been doing this for several years are the ones who can only understand this. And it makes you veer away just because it seems like it's maybe too much work, or too intimidating, and such that the stock market already has its level of taboo and intimidation where you can lose money here, and then there's just this extra mile you have to go where it seems like there's all this math involved and pattern recognition. It makes it very hard, but I just wanted to serve as an example that this is possible. This is possible. This is an avenue into actually understanding how the stock market works. Not just that it goes up and down, but actually able to read it as if it was a paper. Just it becomes its own language that you just naturally get a sense of understanding. So in terms of being able to make it as simple as possible through observation and repetition, you will learn this. It will come to you, and I just hope to be the introductory matter that brings you to that part of your journey. I promise you, you will get this. Okay, so let's hop into this. Okay, so with the basics of reading a chart, I wanted to go over just identifying overall trends, right? So this platform that I'm using, by the way, this is tradingview.com. And it's a free website where you can look up the chart of any stock. And this is what I use primarily, just to read charts all the time when I trade. So in identifying a trend, you can look back over the course of a few days, the past week, 3 months, 6 months, 52-week range, which is a year, or several years, And overall, from the way that the price moved within that range that you're looking at, it gives you an overall sense of how the stock has been moving, what the trend is, right? So let's take the S&P 500, right? And so we're looking at this right now, with SPY, which is the ETF that follows the S&P 500. If we go back 5 years, right, we can clearly identify that it's been going up, right? And so here, if I take a drawing tool, which is you can draw a trend line. So I'm going to use purple for this. You can clearly see for the past 5 years, this went up, right? It was clearly very consistent in terms of how it was moving all of that time. There was a slight pullback in 2018, it looks like. And then after that was over, it started going up again. And so after it started going up again, then the pandemic hit and we fell, right? The S&P 500, by the way, it tracks how the overall market moves, or typically people use it as a reference for how the market's moving. It kind of overall references like tech or some of the biggest bought companies within the ETF. And so when the pandemic hit, right, everything fell very sharply. within that time frame. And so after that, we converted to a downtrend within that time. So over the course of from the late February to March, it was a clear downtrend as the market crashed, you know. And so identifying trends is important because, as I've been stressing throughout the book, you want to know what direction the market is taking, and you want to go along with that direction. You always want to follow where the market is going, where the big money is going, because remember, institutional traders are the ones who are controlling most of the movements in the market, more so than retail traders. So we just have to follow in their footsteps. So within being able to look at those trends and then drawing these lines, this is where you get your first indication and your first lesson in terms of seeing like how things move, you know. So even if we go back all the way to 2009, if we went to 2009 all the way till today, this is kind of a, you know, if we were to draw from the bottom of March 2009 all the way to somewhere up to today, there was a clear uptrend in the overall market for 10 years. You know, there were some pullbacks in there in between, you know, where the market may have sold off a little bit, like the housing crisis happened around in 2011 or so. But we recovered, had some slight pullbacks again, kept going. And, you know, the market has been overall bullish. You can see from its beginning that I guess as we innovate and grow overall, the market in general has been in a consistent uptrend. But it depends sometimes on the market conditions, whether it's like election or just something happening in the world, like the market might pull back where investors get scared. But that, you know, so we've covered a lot of how the market really moves in general, right? And so furthermore than that, I want to cover what a candlestick looks like and how it works, right? So what is a candlestick, right? A candlestick is the price movement in a certain period of time, right? And so it's how much the stock moves within a period of time, right? And when you're reading a chart, you can look at these candles, which is these periods of time, on different time frames. So if we go in the top left, you can read these candlesticks on a minute, 3 minutes, 5 minutes, 15, you know, or 1 hour, 2 hour, 3 hours, or a day, or a month, you know, all the way up to there. And so overall, right now I'm going to use a day because this is sort of a very common time frame used for identifying like longer term trends, which, you know, can benefit with swing trading or just long-term trading. So I'll use that for now. So on a candlestick, there are a few components. So there's an opening price, there's the closing price, and then there's the high and the low. So for a green candle, the bottom of the rectangle is where it opens at. And the top of the green candle is where it closes at. And so it was green because there was a lot of buying. It was more so upward momentum, right? And so the high is right, or excuse me, the open is here and the close is there. And then on each side of the candle are wicks. And so we have the low of the wick, and then we have the high of the wick. And so the low, and so overall, this is happening in the span of this time frame. So this candlestick is one single day, because remember, we're on the daily chart. So in one single day of trading, this stock opened at 298.07, which you can see on the right, and it closed at 306, or rather 307.03. That's where it closed at, you know. But so it opened at the 298, and it actually hit a low of 296.76. But it didn't close there. It fell, but it went all the way back up. And so it actually reached the high of 308.24. But the stock market ended up closing. And so if we look at the 15-minute chart from this day. Oh. Let me make sure I didn't lose it. I might have lost it. Okay, let me just make sure I see. So this was from June 15th, right? So if we go to the 15-minute chart. Sorry for all these lines. I've been doing a lot of charting lately. So here, right? So we went from the daily chart all the way to the 15-minute chart. So you can now see some of the smaller movements within that day that we're looking at, right? So if you see, the lines remained consistent with what we drew before, but now it's just on a different time frame. Now we're tracking this day by each 15 minutes, you know. So from open to close, you know, from 9:30 a.m. EST to 4 p.m. EST, from open to close. So it stays consistent here, right? We opened at 298.04, and it fell for a little bit at first, and that was our low of day. But it kept, after it hit that low, so it fell, it bounced right back up, and it closed. And so this single candle then closed at 298.75. So, and then it continued on, and so overall the stock market on that day looked a little bit like this, right? So if you use Robinhood, you know, it shows these sort of lines like this. That's what the market was looking like that day. So it moved up, and it was just up, you know, some slight pullbacks, just like that. And again, so over here we have the high of day. It closed right there, or excuse me, the high of day hit up there. It stayed consistent with what we saw before, and it closed right here. So that gives you an overall example of how a candlestick can open and close, right? So I want to go back to the daily. So the way that you read the candlestick chart, which again is price movement in a certain period of time, it can give you, by being able to read it, as I mentioned, the open, the close, and the high and low, there are certain ways where you can read it, and it gives an indication about what the market is going to do, or like what an overall trend may be, you know. So within this, there are a few examples of candlesticks. Excuse me. So for here, the one we identified before, that's a very bullish candle, right? Because there was a lot of buying, and it was green. And it gives a lot of, and since we're on the daily, which tells the overall longer term trend, if you see a very strong candle with not long wicks on each side, it gives a pretty clear indication that, at least for this day, the market is very bullish. They want to see more upside. So after this day of a lot of buying, the next day was also green, you know? So this bullish engulfing candle, it shows a lot of strength for the stock, you know? And so next I want to sort of diverge from that and show what can be something where it shows a reversal is in the opposite direction, you know? So besides normal candlesticks like this, you see some of these candlesticks that have like a sliver in between, right? And so this type right here is called a doji. So let me label that there. Let me label this bullish engulfing candle. So what is a doji? A doji is where the opening price and the closing price are nearly identical, right? So on this day, on May 30th, 2019, SPY, it basically opened and closed at the same price. And so when it opens and closes at the same price, it kind of goes to show that the buyers and sellers in the market are very equal, and there's not really a decision to be made on either side, right? Which can signify, depending on what color the candle ends up being, it can signify a reversal. So if we go to this date, May 30th, and we go to 15, just to see like what it was doing on that day, right? We go to May 30th. So on May 30th, oh, huh. Well, some reason it's not showing on my chart. Oh, I'm sorry. Let's see. Okay, I'd gone much further back than anticipated. I had the date wrong. So on this day, on May 30th of 2019, it opened right here, right? So let me get the drawing tool. So it opened right here at the top here. And it closed at the same, like at basically the same price, if you can see that. Oh, sorry. Having some technical difficulties here. But I just wanted to show you, like, overall, this one, it's the price opened here, right? As we discussed before, on the green candle, it opens at the bottom and it closes at the top. And so it opened right there, and the day closed right here below. So the day closed below the opening price, right? So we could say that the opening is orange and then the close is blue. So the difference there, it closed lower than it opened, but it's super close, you know? It's only, this one's 279, 279.10 or so, and then this one is 278.95. So it's only a 15-cent difference between the open and close. So this was a day of a lot of uncertainty here in the market, you know? So since there was uncertainty, it was just trading up and down, not really a clear direction. And so overall, since there was just uncertainty, it seemed like more selling on this day because it closed red. The next day, the market fell, or rather SPY fell. You know, SPY gapped down to the next level. And just to interject, a gap down is a significant price drop from one day in the market to the next. And it creates a gap. You see, there's a gap right there. And so it actually gapped down because it was a reversal. It signified a reversal in the market. So hopefully no technical difficulty again. But if we go back to that same day, it's just exactly what we were talking about. That this doji, so that's what a doji means, that when the price opens and closes around the same price, that there is a battle between the buyers and sellers, or the bulls and bears, and wherever it closes, it can strongly signify a reversal in a certain direction. You don't always know what it might be because it always depends on news and market conditions, but it can give you an indication that a strong move in the opposite direction is coming. And you see it here as well, right? So right here was another doji. And that doji ended up going up. It showed a reversal to the upside. And then another one, a reversal to the downside. And so you'll see this all the time, you know. And it often doesn't, or rather, you know, within all of what we're doing with technical analysis, these are just to read the charts, and it gives a visual understanding of what the psychology behind all the trades are happening in the market at the moment, you know. So because overall the market is driven by psychology, it's driven by decision making between the institutional traders, what they're doing with their stocks as it relates to what's happening in the outside world relevant to news. And what candlesticks give us is a great opportunity to visually see how that is playing out in real time. And people did all this research and in learning these patterns and learning what all this means, just so that it will benefit traders like us to make sense of it and use it to our advantage. And that's what we're doing here. Another type of, and what I'll sort of cover finally, is reversal candle, or rather a reversal hammer. And so a doji can signify a reversal or just a battle between the buyers and sellers where it just becomes stagnant, a bullish engulfing or a bearish engulfing sometimes. You could say that over here was bearish, this strong red candle. Whoop. For some reason I can't create a new text. But this one's bearish over here. Let me just type that. So the market fell, I'm sorry I keep saying the market instead of SPY. It's just I'm so used to using SPY as a reference for the market. So I just sort of use it interchangeably. But SPY fell, now it's bearish. And so a reversal hammer is one like up here. So I'll say hammer. And that one also depends on whether it's green or red. But the logic behind here is that it opened at it opened at that price and closed similar to that price, and we see this huge wick right there. And that wick showed you that there was a lot of selling, because remember, it's on the bottom side here, because we opened right there at 296.09 and we closed at 295.89, and within that trading day we went all the way down and then came all the way back up. And within that can, if we sort of zero in on that, so let me just remember the day so I don't get lost again. June 15th, 2019. If we go to that day, it looks exactly how you anticipated it, because we opened at that price and then we closed at this price. And then within this trading day, we went all the way down and then came all the way back up like a V shape, you know? And this is sort of exactly what that wick that we saw, where, and I'll draw this right next to this just to make it like much clearer. What we saw was the daily candlestick. It looked like this. Let me color this a different color. So this I'm gonna make red, and then make this red. Right. So this is what the daily candle looked like, where we had this box and then the long wick. And this is how that day actually looked like in real time. If you compare to what the daily, which is the long-term candle, and the 15-minute candles look like, where we opened up here, we fell all the way back down, and we climbed all the way back up, which was like a reversal, and closed right there. See, that's how you see the different time frames in real time. And this, all it is just showing the data differently. This is just showing the data on relevant to a single day, while this is showing the data relevant to 15 minutes within that day. And you could always go like further, like even smaller, from 5 minute, 1 minute. But I typically like the 15 minute and the 1 day, because they show trends more often than they don't, right? So I wanted to cover that. That can also signify a reversal. And you can do a little bit more research on this, especially like because there's many names to a lot of these candles that I don't personally use off the top of my head. I always try to use sort of the frame of reference, like something having a long wick being a reversal, something having a doji, which is what we saw was the slight price in between where you don't really see a direction. I like that one as like a potential reversal or trend change coming. And then the bearish engulfing and bullish engulfing, it kind of shows you just upwards trends, right? And so I'll come back to this a little bit later. I just want to make sure I move forward and make sure that I'm going according to this plan here. Within there, I just sort of explained time frames, and I want to go into a little bit more detail there on time frames. I use the daily chart because, again, it shows you more information over a long period of time. because the longer period of time, you don't have to see all of the data that you don't need to. And what I mean by that is when you're going far back, let's say we went 5 years, right, back on this chart. Like, we don't really care at this point in 2020. We don't really care about what happened within the 15 minutes or 5 minutes on one of these single days back in September of 2014, right? That doesn't really give us a lot of information when we're trying to look at the longer term trend. So from day to day, or at least on this chart, it's 1 week. From week to week, it's showing, we can easily see from week to week over the period of year, it was going up, you know? But if we go towards a time like up to what's happening today, right? And let me get rid of all these lines. When you look at the 15-minute or even the 5-minute, you see some of those smaller movements happening to get a overall sense of what buyers and sellers are doing within that period of time. And so you use that, and you use these different time frames depending on the situation and what you're trying to do, you know? So let's say someone who's a day trader and someone who does not want to swing, and swinging is buying today and selling the next day or a longer out. Someone who wants to day trade, right? They don't care about what's happening or what's going to happen over the next few days, because they only care about what's happening now. Sometimes with day trading, you can make a trade and be in and out within 5 minutes or 2 minutes or even a few seconds, right? And so with identifying patterns to day trade, you have to really be keen about what's happening in those micro moments, you know, because you're not really looking towards longer term trends. And as we said, the daily chart is for longer term trends. You want to look at shorter term because you're trading shorter term. So with a 5-minute chart, you see all these movements happening within the 5 minutes, and you're able to visualize it on these charts directly. So let's say if I wanted to make a trade and be in and out within like max like 30 minutes, right? You could potentially see an entry right here, right? Because again, we saw, it looks like in this case, we saw a slight reversal. We saw a slight reversal. And so possibly someone wants to buy at where the yellow line is. And within, like, it opened right there. It's possible they sell right where it closes. You know what I mean? So let me redraw this a little bit. It's possible that they buy where it opened, which remember is on the left at the bottom of the green candle, and sell at where it closed. So within that 5 minutes, this candle was all green. So it's possible if they entered right where it opened that they made money off of this let's see, this is like 50-cent move or so, like 80-cent move. They made money off this 80-cent move within 5 minutes. And some people do that. So they were in and out. Or they could have held a bit longer and potentially caught like this green candle as well. They entered down here and exited at the top here, which was about a $2 move from bottom to top. And that was probably important for them on that time frame. And if you were looking on the higher time frame, you wouldn't have seen that. You know what I mean? So on the higher time frame, on 15-minute, like, this is pretty strong. and it's possible you could have used it, but it's possible you don't know what could have happened within the micro moments between these two candles, right? Because on the 5 minute, there's more. But on the 15, you see that here, at least, it may have shown that this was a bullish moment. Because if you look at these green candles here, I'm sorry, this thing is so bad at drawing circles. If you see here, this moment, it outweighed this red candle over here. And that's why it's often called like bullish engulfing, because overall it engulfed this past candle, which may signify a trend reversal in the opposite direction. And you can sort of see that clearly, right? It bounced at that moment. It bounced, and then it continued upwards a little bit for a certain amount of time. So contrary to the 5 minute or 1 minute, also I just want to demonstrate the 1 minute. The 1 minute gives you way more candles, right? Because it's everything happening 1 minute at a time in the day. And I don't often use this personally because I'm a swing trader for the most part. But people often use the 1 minute because, again, they if they're day trading, they want to make sure they catch all this momentum within these smaller movements. Personally, it's just a lot of information happening for me, so I don't really see trends or patterns on the 1 minute, because overall I believe you can get more information about an overall trend from a 15-minute chart, at least within like the intraday trading, because the 15-minute has more data and it's 15 minutes at a time, and so you can identify a pattern that's happening just over that range of time. The more range, the more it feels you're able to see like that pattern or that trend. While within a 1 minute, or sometimes even the 30 seconds, it's all these things happening, and it's like information overload that you may not see what an overall long-term trading trend is within there. On the 15, that's where you're able to see longer term, and where sometimes I make my entries so that I can go long, And so just to recap, the 1 minute and 5 minute are very useful for day trading, and I would say the 5 minute is also useful for making an entry, while the 15-minute and the 1 day chart are good for trading long term and going long on a position, because you're able, with the longer time frame, you're able to see more data visualized and fewer candles, that you're able to actually identify that pattern. So next, I want to discuss support and resistance. And so support and resistance is very simple, and I want to make sure that this is explained very simply, and because it's very easy to get the hand of it, and it's very useful to use in terms of trading, because it gives your overall indication of where you should enter or where you could exit. And just want to make a timestamp. Okay, so let's go to a different stock. Let's do a stock like AMD. So on AMD's chart, we can see, and I want to just use, or excuse me, I just want to define what support and resistance is. So support and resistance is, support is just the level at which the stock found a bottom, or the most recent lower level it hit, and resistance is the high level that the stock recently hit. So if we're looking at like today on AMD, we could say that it has resistance somewhere down here at 77.69, right? Because it made a low right there, and it never got lower than that. So I'll color everything that's a support as blue and everything as a resistance as orange. So there was a support right there because it hit that low. And what that means is that it didn't, why they define it as support is because the price itself is supported at that level because it didn't fall further than that. And what we look at as resistance, we look at as resistance is the previous high. So for the previous high, we could say right here, possibly, right? If we were looking at just today, or even up here. It really is, and I want to make this clear, that because it depends on the time frame you use, but it really is like the high of day, the low of day, or just like a recent low. And it depends on the time frame you use. But you can use these points at which as a reference for the price action that it can reach for the next level, right? So I just want to make sure I'm clear about resistance, right? So here's a good example I'll use right here. So if we go back from today again, and I'm going to go on the 1 hour chart actually. If we go back from today, AMD hit 87. So we're low here, and there was a recent high up here. It hit 87 right here, and it actually pulled back from there. So because AMD went up and it fell down, whatever high it reached is the resistance, because it resisted breaking above that price. It resisted breaking above 87. So it hit that right there once. If we look back, it actually rejected around that level right here too. So there's 1 and then 2. We go back, there's 3 right there, right? So that happened on August 26th. And then right here as well, August 7th. So it hit the same level of 87 and pulled and fell right after, like each time. And so when a stock hits a level and rejects it several times, that's the stronger that the resistance gets. And basically what that means logically is that AMD struggles significantly to get over 87 and stay there, right? Because there's a very strong resistance at that level. So here in this moment on August 31st, it was able to break 87. It broke 87 like firmly, and it hit a high of 94, right? And you can even draw a resistance up there because again it reversed and pulled back from like that high, and so you could use that, and that's like the all-time high, right? And so after it fell from there, it struggled since then to get over 87. It still hasn't, so you see these 4 points, it still hasn't broken over 87. Now, on the flip side, if we look at resistance, you see I drew this blue line for, or excuse me, I'm sorry, let's look at the flip side for support. I'm getting messed up with my words. It's getting late over here. So with support, I drew the support line like down here just from, this is like the most recent week of AMD. So because it found the bottom or reversed upwards down there at 77.69. And so if we look back on AMD, you see that there were other lows. If we can find, there's if you can visualize this, there's a low down here, most recently right there at 74-ish, right? At 74. So if we can draw a support line there, let me color that blue for support. And so if we do the same thing, right? I'm gonna color this purple, right? There's 1. There's 2. It hit that 74 level. There's 3, 4, maybe, like, but in this range on that day. And yeah, and then right here. So if we zoom out, there's 4 there as well. 4 circles, just like the 4 on top of the support or on the resistance. So on the support, because we drew like the previous bottom levels, you can see it has strong support at 74, right? So over the course of the past few months, AMD has not fallen below 74. And if it ever did, it was only for a very brief moment. So, and that shows you that institutional traders see 74 as an ideal buy moment because it doesn't fall below there. And I feel like if it were to fall below there, then it would fall very harshly because then it no longer has support. There's nothing supporting it up anymore. So if AMD were to fall below 74, I feel like it would crash. It would fall very harshly. But from what we've seen, the institutional traders will not let it fall below 74 no matter what right now. It seems like that's the level that it just can't fall below. And then on top, 87 is the level that it just can't get above for very long, you know? And so if we remove like these these intermediate support and resistance lines, you then see AMD has been trading sideways. And that's how you identify a trend right there from the support and resistance lines, just like that. You can go to the 1-day chart and you see it's just bouncing up and down in between what we would call a channel, a sideways channel. It's bouncing in between this support line and this resistance line. And it's struggling very hard to get above. So you can trade within these few points where it looks like almost as if it's a zigzag line, you know? And I think that's very important to know when it comes to drawing support and resistance. So just as a recap, you draw resistance at a recent high and you draw support at a recent low. So now I want to dive into some of the indicators I use. Okay. So some of the indicators I use are volume, the moving averages, EMA 9, and VWAP. And so volume, as you know, as I've explained, is the amount of transactions or the amount of people trading within a certain time period. And you're actually able to visualize volume on a chart. So you can visualize volume here. And so this indicator is actually called R volume. And the way that this sort of works, and I'll sort of explain this a little briefly, is where there's low volume, there's low amount of transactions happening, right? So these are those gray bars. The gray bars here, there's just lower volume, you see that it's a lower level, and the higher bars mean that there's more transactions happening, there's more people trading at that moment. And when it becomes a green line, it basically crosses over this, this other line, or it becomes a green bar, or you see it shoot up, there's a lot of volume. There's a lot of transactions happening. So if you were to look at the open and close of any stock, for the most part, they're always going to be like a huge volume, because the first 30 minutes and the last 30 minutes of each day are the most volatile moments of the day, because that's when most people are trading at one moment, typically. Because there are many traders who only trade the first 30 minutes and that's it. They don't trade the rest of the day. They just the first 30 minutes, you know. So that's where most of the transactions are happening. So you can see volume spikes happening there because there's more people, there's more transactions. And so you're able to visualize this on the charts, right? And so why it's important that you look at this is because you want to make sure that you're trading alongside the momentum or the movement of the volume as well. So not even just looking at the charts, but seeing like if there's a lot of people who are even trading in that moment. And if you're seeing a lot of people trading in that moment, that lets you know that there's a lot of demand at that moment, you know? So let's go to a stock like Tesla, if we may, right? We could go back to like Tesla back when it made its crazy move, right? Compared to, let's say, August 12th, right? Before August 12th, Tesla volume was kind of low, right? Because you can see that by these bars at the bottom. It's like really low, you know? It's like okay-ish. But when they announced their stock split, Tesla volume shot up. And there was serious momentum happening here, you know? And I want to make sure you can see this more clearly. So on these days, you see these several green bars and a lot of volume. So there was this consistent, a lot of volume, a lot of demand for Tesla after they announced the stock split on August 12th. And it just moved up, it flew. The stock price just like quadrupled almost in that moment, right? And it went up super high, but you can see by the bottom that there was just a lot of transactions happening in that space of time. And you want to be able to see that so that you can catch the momentum of the stock and make sure that the stock has interest in it. So next I want to move on to the moving averages. So let me use a stock like Square or so. So I use this indicator, which is called all moving averages. I'll just search it. So on TradingView, you can search an indicator. So if I search all in one, I use the all-in-one moving averages simplified by Ismail Tarim. And so you can go in here and you can edit it. And what this gives me, right? It gives me the 20 moving average, the 50 moving average, the 200 moving average, and EMA 8, which I sort of double as EMA 9, and then a few others, right? And so the 20 moving average, the 50 moving average, and the 200 moving average I use because I think they're probably the most reliable moving averages, and they give you enough data, I think, to trade long-term and short-term. And so what a moving average is kind of almost self-explanatory, right? It's the average price that the stock has moved over a certain number of days. And so the 20-day is how the stock moved on average the past 20 days, and then next the 50-day over the past 50 days, and the 200 over the past 200 days. And so using them in unison can give you some data about just overall what the price movement is happening. So I would say the 20 moving day average gives you an idea of how it's moving like more recently in the average of like a very recent price, while the 200 tells you like long term, like what the overall like bigger trend is of the stock. Similar to how we were talking with the 15-minute time frame versus the 1-day time frame. It just differentiates based on the data, you know. And so what I want to clarify here is that the 20-day is going to give you that recent data, and you want to compare and contrast how they're interacting with each other, you know. So let's say a stock fell considerably, right? Let's go back to the pandemic, right? when the pandemic started and it fell, at the very bottom here, you see that before the pandemic, it was above these moving averages. And so these green lines are the moving. So the lighter green one is the 20-day, and the darker green is the 200. So you see that the stock price itself was above it for the most part. They were above all of the moving averages. And then when the pandemic hit, it tanked. It fell like super hard. And now the stock right here in this moment was below all of the moving averages. How would you use that information? So when the stock was below all of the 20-day, which is the most recent, as well as the 200-day, it can potentially create a buying opportunity where it's definitely oversold, right? Because below the 20-day and the 50-day, and it has to catch up. Eventually, stocks have to even out, right? There's always this level of balance within stocks, where something can be overbought or oversold, and it depends on how the perceived value of the stock and how it's trading. Of course, there's all these other values, but in here, you can use the moving averages to tell whether what that trend is, similar to what we were just discussing, as well as seeing if something is overbought or oversold. So at this moment, this was definitely oversold. And by being below all the moving averages, it's creating a buying opportunity that it had to go back up at some point, right? So at this moment, all the selling kind of evened out, and a lot of the investors in the market decided, okay, like, we've sold enough. Now we want to buy low and sell high. And this is the low that they decided was the lowest low that they were going to use, and transition that to selling at a later point, at a higher point. And that was all displayed by it being below the moving averages. Another thing you can use is something that's called a golden cross. A golden cross is when the 20-day moving average crosses above the 200. So, and in other terms, that's saying when the short-term moving average crosses above the long-term. And that signifies a whole trend or reversal in terms of the overall trend, right? Because as I explained earlier in the video, during the pandemic, obviously it was a downtrend for like all of March, just because the virus was spreading. People didn't really know what was going on. And then at that moment, eventually you see that after it evened out, that there was a potential uptrend that was started. And it's signified by that moment when the 20-day crosses above the 200-day. And so it pulled back again, and there was still some price action overall. And you can see this, that was like the 15-day, or excuse me, the 15-minute. And so this changes depending on what time frame you use. So maybe there, that was an indication of a trend reversal, maybe shorter term. But on longer term, let's say on the 1-day chart, the 20 ended up crossing the 200 right here. That's another golden cross. And so when that happened, that was definitely showing that there's a long-term trend in the opposite direction, upwards, right? At that exact moment. And so maybe people bought right there, and that was their buying point instead of down here. They bought right there for confirmation. And then square from May all the way till basically today has moved up on an upward trend. So you could have bought right there as you saw the 200 and the 20 cross right there. Buying at a price of about $73, you could have rode your way all the way up to $200. And that would have made you a lot of money. And so that's how you can use the 20-day, the 50-day, and the 200. The 50-day also you can use if something's below the 50-day. It creates a buying opportunity. I sort of said also that if it's below everything, it creates a buying opportunity. But that's how you would use those moving averages. Just to go over EMA 9 or EMA 8, I sort of use both interchangeably. That's the exponential moving average over a period of 9 days, or possibly a period of 8 days. And so the EMA 9 just gives you more weighted significance over recent price movements. And that's this red line here, by the way. The red line is the EMA 9. It gives significance over recent, so it gives more of a recent trend instead of a long-term trend. So you can use the exponential moving average for more recent trends, depending on what day frame. And I like to use the one that's number 9. And then finally, I want to cover VWAP. And so VWAP is this this blue line here now. And so what VWAP is the volume weighted average price of a stock. And so what the VWAP is, that's a financial term for the ratio of the value traded compared to the volume over a certain period of time. So it tracks all of this, a lot of the price movement relative to the volume that we discussed earlier. And so then that becomes a trend of price action versus the amount of volume overall that happens. And in when used alongside EMA 9, it can be very useful for identifying a breakout pattern, which I cover in a different part of the book. And now, common patterns that I look out for. So all this will be time-stamped. Just want to make sure I have everything. So there's a number of patterns to look out for. And before I go into this, I just want to be very clear that while I'll cover a few patterns, it's very useful to just learn one pattern at a time, right? Because this is all about repetition, right? And if you get caught up in just information overload and trying to do everything at once, you're not going to actually absorb any of the information that you're trying to handle, you know? So if you just dive into one at a time, then you'll actually feel confident in yourself, because all of these patterns happen all the time. It's a cycle. You see them all the time, but you have to be able to be prepared for those times when they come. So how are you going to prepare yourself? You're going to just practice. You're going to practice and repeat it over and over and over again. And you have to probably see which one of those patterns work best for you, you know? And so, the first one I want to go over is a bullish pennant. A bullish pennant is when a stock will kind of squeeze between the high and low into a triangular type pattern, right? So here on square, you can see that let me hide all the other lines. You can see in this place right here is squeezing into like a smaller triangle here, where it's making higher, it's not making lower lows, it's making higher lows, right? Because each candle, you see, the bottom is higher than the previous because it's climbing up. And so after the price first went up and you see this triangular pattern, it can squeeze up, down, until it breaks. And it can break upwards. So we call this a bullish pennant because, the bulls are typically when stocks go up. It squeezed out at that moment and it shot up. And so that's what you typically want to see within a bullish pennant. And you can compare what I'm talking about to a Google search of any of the images of any of these patterns, where it just squeezes up, it squeezes, higher lows, and then it breaks out upwards. And so that's one I definitely sort of look out for all the time. I think that's one of the most reliable ones, especially when used with the EMA 9 and VWAP. It really gives like a clear indication that something's about to break out. And so I'm using this on the 15-minute chart, but you can see this happen on like the daily chart as well sometimes. It depends on just what time frame you're looking on. But the 15 in one day, I use the most just to see for swing trading, right? So it's possible on this chart, as we were identifying, that it was squeezing out within this bullish pennant. And let's say you were attempt or expecting a bigger move to the upside, you could have bought like right there. And you're planning on swinging into the next day, expecting some upside. And so you bought there, and then the price shot up. And then you sell right there. And so you bought low, you sold high. And because you charted it out, expecting a break to the upside. The next pattern I want to cover is a cup and handle. And so a cup and handle is another type of bullish pattern. And I'll explain like what it looks like real quick. So I'm sorry that this is so messy. So what a cup and handle is when a price is on an upwards trend. Oh, down here is a better example. It's when a price hits a certain level and it's on an upwards trend. So let's draw this here. It was moving up. and eventually it hits a top right there. And let me zoom in. And then eventually pulls back. So it's an upwards trend, hits a top, falls back down, hits a bottom, and then comes back up. So this is a cup, right? So the cup is like a U shape where it hit a top, it fell down considerably, and then it recovered all the way back to that previous high. And then there's the handle where it pulls back slightly some more again until it shoots back up. And that's how you fulfill a cup and handle. And so in identifying this, you'd want to see some of the pullback, and then at some point where you would want to enter is maybe somewhere at the bottom, right there or so, right? Where you see some snapback to the upside. And so you catch the bottom, and you don't maybe because at this point, right, the cup and handle wouldn't have even formed yet, right? It would have went down, and then all you have is right here. But you're buying right there because you anticipate it to come back up, right? And it fulfills the cup. And then after the cup is filled, maybe you took profit already, you're already out. Let's say you want a new entry. Now you see that if, let's say I were to pull the chart over here, right? So let's imagine that we don't know what's coming next. You see that it filled the cup all the way up. What would your next anticipation be of what the stock market or the stock does? What's it going to do next? Well, you're anticipating the handle. And so the handle is the slight pullback. And you see it fell down right there. This is the slight pullback. That's the handle. But then after that, it's going to pop right back up. And then so where you would want to, after you anticipate that it pulled back for a little bit, maybe you played puts at the top, or you find a new entry to go long. And so then you make like a call option right there to go long. And then it snaps back and it keeps going up because you identify the cup and handle right there. So that's a bullish pattern because it shows a recovery. The logic is it went up, the stock fell down, but it showed a full-on recovery back to the previous high, the previous resistance. And then maybe it pulled back a little bit just from some selling because it hit the resistance. The selling is caused by the resistance. But then eventually it shoots back up because after it recovered, it showed that the stock had strength, that it had enough strength to drive the price even higher. Another pattern I want to cover is head and shoulders. And so a head and shoulders is a bearish sign, right? So I want to make sure covering everything. So a head and shoulders is what we see right here on SPY. Or maybe, let me see if Tesla has a better example. Okay, so yeah, Tesla probably has a better example. And I'll draw this out live, okay? So what a head and shoulders is, it's when, and I'll show you a bit here. This might be a little bit of a ghetto head and shoulders. I'm trying to see what's the best example. I'll just use like right here, where So this isn't gonna be perfect. The one on SPY before kind of showed a bit more perfect. But head and shoulders is basically when a stock goes up, it pulls back, it goes up a little higher, pulls back, and then bounces to the previous level where it had hit the high on this level. So this is kind of close enough where Tesla went up, it hit this level, and then it pulled back and then went higher. But then, after it begins to fall again, buyers try to buy it up thinking to get a low right here, but once it turns one more time, that shows a weakness for the stock. That the stock wasn't, so for example here, Tesla wasn't, after it bounced back up, it didn't move higher. It didn't show strength. It showed more weakness. So it fell right back down with more sellers coming in, right? And so if you can sort of picture that, let me go to maybe a shorter time frame from there. Whoops. From there, and I'll draw this once again. This is supposed to be the head up here. So I'll draw like a smiley face, right? That's the head. And these two are the shoulders, right? These are supposed to be the shoulders of the body. This is a bit, it's not fully it, just because Tesla had this spike over here, which would incomplete the head and shoulders. But overall, that was the pattern that I showed you on the daily chart. If we go back to SPY, over here was like a smaller head and shoulders, like intraday. If you go to like the 5-minute chart. So this one's better because it went up. Let me get rid of these lines. It went up. It retraced a little bit. It hit a high. It fell and it tried to recover, but it couldn't because it didn't have any strength. It fell even further throughout the day. So that's like a bearish candle that you could, or type of pattern you can look out for. And again, like these happen all the time. You can find them all the time. And so in closing, because I don't want to really go much further, I just want you to use some of the patterns I used and discuss, or use some of the patterns I use. The bullish pennant I showed you, that's the one that I use the most, and it's because I see it all the time. These patterns you'll see all the time, but you don't want to keep looking for everything and everything. And also sometimes you might be wrong, because everyone might see something differently, but you have to at least practice enough and see it enough so that you can anticipate it in a timely fashion. You know what I mean? And the way to learn and actually grow from this is, again, practice and repetition, but also by asking questions. Ask questions, see what other people see. See if they see the same thing that you see. Because we may all be seeing something different, right? So here, for example, like here's another cup and handle. In this case, SPY, and see, I'm just noticing this right now. In recent memory, SPY, it hit a high, it came all the way down, it hit that same level from before, pulled back a little, and went up higher. There's another cup and handle just before my face, right? And so you can see those things just happen like constantly, but it's just about asking questions. It's about rinse and repeating. And you will get this like over time. You will just keep seeing the same things over and over. You can ask other people questions to see if they see those same things over and over, because this is what's crucial to where you will see like how the stock market is moving. You know what I mean? And if anything here like didn't may not have clicked initially, like feel free to ask me questions. Feel free to contact me or book me for any sessions, because I really want to make sure every single person gets this. I know at some points during the video is like a little scatterbrainy, so hopefully some of those parts weren't confusing. Just to recap here, I want to make sure like I recap. A candlestick is a price movement within a certain period of time, and you can change the time frames on whatever you chart on. You can identify some of the attributes of what a candlestick means by how it looks, and that's whether it's bullish, whether it's bearish, whether it's a doji, which is in the middle, and then really apply what those mean in your everyday trading and just watch it. Just watch the charts, look at the take what I gave you and see what happens and how it reacts. If you don't want to use your money while this happens, like feel free not to. You know, you could always paper trade or just watch, just so that you can study, just so that you can see these things happen in real time. And so the candlestick, it has the open on green candles at the bottom and the close at the top. And then on the red candles, it opens at the top and then closes at the bottom. The time frames I use 5 minute for day trading. I use 15 minute for and 1 day for swing trading. Support and resistance. Support is drawing a line at the previous bottom, and resistance is drawing a line at the previous top. And what those mean are based on how the price movement is moving, and you know what the price levels can get to or fall to. The indicators I use are volume, the 20, 50, and 200 day moving average, EMA 9, and VWAP. And the common patterns I look out for are the bullish pennant, the cup and handle, and the head and shoulders. And there's many other patterns that you can learn, and just feel free to learn them and see if you can apply them to your everyday trading. I hope this was useful, and I really want to make sure that I get all questions answered. So anything here that I may have not covered, feel free to reach out to me and I'll maybe include it in another video. But thank you for watching, and be safe, be cool, and be ready to learn. This is Kiakili. Thank you.